Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
This week on Wall Street Wrap-Up, last quarter's GDP numbers were released, and we'll tell you if the economy is slowing or growing. Wall Street was euphoric over the news and numbers this week, as it showed it by more buying than selling. And just like a party where you're having fun, maybe sometimes too much fun, there's one in charge to come in and take the punch bowl away and flick the lights and tell everyone to go home. Will this be the man to do it this coming Tuesday? I'm Andre Laborde. We've got these stories and more. It's Friday. That means it's time for Wall Street Wrap-Up. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up on this Friday, January 27th. Well, this week, the stock market had a powerful rally with yesterday's economic numbers, and added to that, American Express released their fourth quarter earnings and had good comments on the health of the consumer. Well, on those 2 points, the markets rallied. Now, we'll be talking about how the stock market will be looking for the first half and the back half of 2023. Because tonight, we're going to be talking with Sandy Villary. He's a partner and portfolio manager at Villary & Company. They've got two mutual funds, a balanced and an all-equity fund. Sandy Villary will be here to discuss the upcoming Fed meeting and this week, and what the stocks he likes and which ones which may rise for 2023. That's Sandy Villary coming up. Well, this week, the stock market advanced for the day, the week, and so far even the month. And, well, since we're in January, you could also even say it was advancing for the year. Today, American Express said that they had the highest ever quarterly card member spending. And the metrics remain strong, still below their pre-pandemic levels. Since the beginning of the year, the S&P 500 is up over 6% for 2023. There have been more stocks advancing than they have been declining. And where sometimes the market is buying either growth or value, both are advancing for 2023. Well, this week in the market, it was the fourth week of gains for the NASDAQ. All the stock indexes ended positive for the day and for the week. And this Tuesday and Wednesday, the Federal Reserve will be meeting to see if they'll be placing a 25 basis points or 0.25% rate hike. Now, if it's higher than that 0.25%, it's going to be a shock to the markets. Well, how did the markets do this week? The Dow Jones ended the week at 33,970, and that was up 1.7% for the week. The S&P 500, they closed today at 4,069, which was up 0.6 of a point for the week. And the NASDAQ, they ended today at 11,620, which was up just about 4.25% for the week. Well, the Bureau of Economic Analysis released the GDP for the country for the fourth quarter of 2022. And the country grew at just under 3% at 2.9% for the last 3 months of the year. Well, now that means that for all of 2022, our economy grew at 3.9% for the year. Well, let's get to our guest tonight. The stock market this week had a big rally, but will it continue? Let's ask Sandy Villary. Sandy is a partner at Villary & Company. Hi, Sandy. Welcome to Wall Street Wrap-Up.
Thanks for having me, Andre.
Sandy, this week in the Wall Street Journal, they said how the market will be depending with inflation of whether or not how fast the recovery will be coming. First off, do you think that we're going to have a recovery in the stock market?
So it's interesting. You look at how all of this began. You know, I go all the way back to 2020 when the Fed just started to increase their balance sheet from 4.1 trillion to 9 trillion, and we had to buy back bonds, and we had quantitative easing and bringing interest rates down to nothing. Well, when you do that, it puts a lot of money in the system, and so we got record inflation. 9.1% back in June of 2022. So when I look at the last couple of months, it is receding, right? So as the Fed has begun to raise interest rates 7 times specifically, all of a sudden inflation is coming down. We saw it at 7.1% in November, and now we see it at 6.5% in December. So I think if the Fed on February 1st meets again, raises another 25 basis points, and then possibly in March raises another 25, we could certainly see inflation ease even more. And I'm looking forward to a good, first half of 2023, which is actually against consensus. A lot of people think it's going to be a tough first half. I think it's going to be a good first half.
When they do meet January 31st and February 1, do you think that the Federal Reserve it'll be 25 basis points, that they won't be higher, or they won't go at 0, but at 0.25%?
And I feel pretty, at least consensus would say that it'll be another 25 basis points on February 1st. So I do think that's going to be the case this time.
You think this first half of 23 will be a good one for the market?
I do. We're in that seasonally very good period for the market. Typically, the market does quite well historically as you go from November all the way through May. There's the old adage, sell in May and go away. And frankly, I do think that we could get into some sort of recession, at least a shallow one. I'm not calling for something much worse than that, because this is, self-made as far as the Fed raising rates to combat inflation and cool the economy. So I do think we're going to have a nice rally all the way through the May of 2023 timeframe. And frankly, once you get into those summer months, and if it's the third quarter 2023 when the recession hits, historically, the 1 month before the recession hits is where you get a pretty tough market. So I'd be more defensive as we get into the back half of this year as opposed to right now.
So are you in the camp that we're not in a recession right now, that we will have a recession? So you think it may be a soft one?
I think it is going to be a soft one. I mean, the reality is, if you look at the jobs reports right now, and there's basically 1.9 jobs available for every one booking. So, and again, this is why the Fed is raising rates. I mean, they're doing it to cool that overheating economy, and they're trying to take the slack out of the job market. So as we watch those jobs numbers, maybe come down and again have some of the slack taken out, then I think the Fed can start to actually go the other way. And I'm actually thinking that by the end of the year, 2023, and I'm talking November, maybe the Fed cuts 25 basis points, and maybe December, another 25.
So you think there's a possibility that not only will there come a time, and will I say this year in 23, where they won't be raising rates, they won't be keeping it as it is, but they may actually be cutting?
That's exactly right. And I think that's why last year the market was anticipating, rates going up and up. And as they did that, the market sold off. Well, now the market's rallying because it's predicting that the next moves, it's already discounting, these next two rate hikes, and it's starting to discount what may happen in the future, which is rates going lower. And what would be a bit of an issue, and why the Fed may stay, kind of hawkish a little bit longer, is that they just want to have a soft landing and make sure that we get out of this without causing more inflation.
You were mentioning about the bond market, and I'm curious because, there's the inverted yield curve where normally you think the longer the Treasury bonds are, the higher their interest rate rather than the 2-year or the 5-year. But right now, the 2-year is higher than the longer term bonds. Do you think that does the bond market lead the stock market, or does the stock market lead the bond market?
That's a great question. I think the bond market leads the stock market, and frankly, that's telling you with this inverted yield curve, when the short end is higher than the long end, that we are due for some sort of shallow recession. It's been a great predictor in the past. What's interesting is had you bought the long end, the 10-year at 4.25, 4.20. I mean, that's not a bad rate to lock in, and again, those are treasuries.
That's a good point. You think about it, the 2-year Treasuries paying 3.4, 3+% for 2 years. And it's locked in, and that's a really good rate, for having guaranteed income. Do you have at Villary and Company? I mean, you've got mutual funds, and you're the portfolio manager Are you the portfolio manager of both funds?
Yeah, so I'm the portfolio manager of not only some of our separately managed accounts, where we have 4 of us that are co-portfolio managers, and then there's 4 of us that are co-portfolio managers on both funds. And so the funds have 2 different strategies. Our balanced fund is basically 60 to 70% in stocks with the balance in fixed income. And then we have an all equity fund that's primarily a concentrated, smaller to mid cap style fund that's going to be a little bit growthier. Which is why it's done fairly well in 2023 as the Fed, is hopefully changing their tune and maybe coming towards a little bit of a pivot.
Sandy, why was it, normally under normal circumstances, which wasn't really the case that much in 2022, when when stocks are down, like a seesaw, stocks are down, bonds go up, and vice versa. But in last year, we had both stocks and the bond market that was in a down position. So do you think that now now that we're in 2023, it's going to be back to regular way of doing business?
Yeah, that was incredible in 2022 because I think a lot of people have always been told you can't lose money in bonds. But if you go back to 1981, when interest rates were so high, we're talking about 18% plus, over the long period, rates just went lower and lower and lower and bonds did quite well. Well, when the Fed is raising rates, bonds move inversely and they go down. And so if you were in the ag, which is maybe a 7-year maturity, you could have lost 15% in your fixed income portfolio. So what we try to do to combat that is to stay a little bit shorter in maturity, and then we try to stay away from things that are a little bit away from less than investment grade fixed income. So we feel pretty good about our bond portfolio, but I think this year bonds could actually do a little bit better.
In both your equity fund and your balanced fund, now that we started the new year, did you adjust anything from last year into this year?
What's interesting is when you look at last year, there was an incredible divergence between growth and value, right? Value was only down about 2% as people basically hid. They hid in the Johnson & Johnsons and the Pfizers and the large cap value stocks and the growth stocks, the FANGs, if you will, the Facebook, Apple, Amazon, Netflix, Googles of the world, sold off pretty sharply, over 30%. So we think that value is a little bit more of a crowded trade. And so we actually tried to sell some of those value-oriented names and maybe come back into more of the growthier stocks that had just been, beaten up for no apparent reason. I think there's a lot of things like crypto, if you will, that I don't think had any reason to be up where it was anyway. But if there's a very high quality, growth stock that has good earnings and a good growth profile, we wanted to buy that at sometimes a 25 and 30% discount, only because it got lumped into a group of stocks that sold off because the Fed is raising interest rates. So I think there was opportunities in growth, and hopefully that plays out all the way at least through May of 23.
In the 1920s, there was an investor named Bernard Baruch, and he always said, always buy when there's blood in the streets. And to a lot of people, 2022 had some blood in the streets. Sandy, you've got small cap and you've also got large cap. And the large cap, you've got more, as you were mentioning before, you got, Pfizer or well-known companies, but they don't have the growth. The small cap, they may not have as big of a name, but you've got more room to run, more of a way to have a better year than others. Do you have a preference?
Yeah, we would love to overweight small and mid cap stocks over large cap. We feel like large cap's a lot more efficient. So it's very hard to get an edge and buy a great company, for example, a Visa or something like that you want to buy at a discount to that growth rate. It's just very difficult to come into a company like that. Historically, we were able to buy Apple years ago when Steve Jobs died. We've sold it since then, but there's got to be a short-term issue or wart on the story, if you will, to be able to buy a high-quality large cap like that. In the small cap arena, there's just a lot of inefficiencies. People don't quite follow them as closely as we do. We're able to talk to the management teams and really get close to some of these businesses and hopefully have an edge and get some outperformance that way. But it was a tricky 2022, but we feel good about 2023 as far as small cap growth goes. And frankly, as you come out of a recession, actually small cap can lead a lot of the time. In fact, 6 times of the last 6 recessions, small cap has meaningfully outperformed large cap. So I think it's probably the place to be, right now.
You mentioned two stocks that were in 2 interesting sectors. Let's say you're talking about Visa, that I would classify maybe as fintech, or as far as that type of a business, and maybe Apple, that might be considered technology, or it might be because they're in so many different types of pots. With technology last year, because interest rates were rising, and as interest rates rise, technology usually gets hit pretty hard. Do you think technology, because last year was bad, do you think that what was bad last year will then be good this year?
I think in general, yes. Sometimes you can go and buy some of those names. However, rather than pick a large cap name, like an Apple or an Amazon, in fact, I think Amazon could kind of be where it is 4 or 5 years from now as the multiple sort of shrinks. Even though their earnings are going to grow, it's one of the greatest companies on earth. But is it one of the best stocks? I think there's better opportunities. And so we like a smaller company called On Semiconductor that's very much involved in the 5G build out, electric vehicles, all the neat bells and whistles on a higher end car as each car gets a little bit more fancy. And we know the CEO Hassan El Khoury has been just a great leader. And we were involved in a company called Cypress Semiconductor that he sold prior. He's just really good at getting rid of the commodity parts of the business, increasing margins up to about 45%, which is where we thought he would be, 3 years from now. So I want to be in a sort of a more of a smaller mid cap to try to get some outperformance over a name like Apple that maybe is over-owned, if you will, and maybe a little bit more of a crowded trade.
What about the Visa you were talking about? I'm thinking of when I hear Visa, I think of Visa, MasterCard, American Express, PayPal, which really got hit bad in 2022.
Yeah, Visa is one of the more high quality names out there. If it's ever something that can sell off, and frankly, we bought some Visa back in January of 2011, if my memory serves, when they had the Durbin Amendment, when Dick Durbin came out and said, we're going to make every swipe on your credit card less profitable at Visa. So if they were making 60 cents, he wanted to bring it down to something like zero. But over the short run, there was going to be a government overhang, and it went from a 20 multiple down to about a 12 multiple. And it gave us a chance to buy that high quality stock and hold on. So there's no real financial risk with Visa. They own the rails, right? They're not lending money. They just have all the rails, and we haven't seen anything as far as Apple Pay be able to displace them. It still comes off your Visa card. So those are the types of high quality names that if they were to dip, that are just great opportunities to buy in a tough market for growth stocks.
Interesting you bring that up because I know Warren Buffett would always talk about stocks that were like toll bridges. And Visa, whether you paid your bill or not, and they always hope, you always hope people pay their bills, but whether they pay their bill or not, Visa already made their money. The moment you swipe it, Visa's money is good as gold already in their account.
Yeah, that's exactly right. And I think Warren Buffett owned American Express, and he couldn't believe that people would actually pay to have a credit card. He's like, this is unbelievable. So, kind of Costco model, if you will. So what a great company both are. But yeah, we like Visa a little bit more, especially if we can buy it on a pullback.
We'll be right back. We're talking with Sandy Villary. He is portfolio manager and partner at Villary & Company. We'll be right back. Glad you're back. We're talking with Sandy Villary of Villary & Company. Sandy, with COVID, had locked down China so bad that a lot of the supply chain issues and manufacturing and factories that were in China, U.S. companies were hurt by this. But now that these factories are getting maybe back running because the lockdowns are ending, do you see the revenues for this coming year, for 2023, getting better?
Yeah, I think, China reopening is just a big deal. When they were in lockdown, it certainly impacted many different companies. And frankly, one that we own is Freeport-McMoRan, FCX. And I think China's 55% of the worldwide copper demand. And so it's really not going to go anywhere until China reopens. And now that they are, I think Freeport's going to be a very nice performer. I mean, they have about 4 times the amount of copper on an electric vehicle that they do on a regular combustion engine car. And I just think that's the type of thing that's just going to be a really nice play as the pent up demand in China. And we saw what happened in the U.S. when we reopened. There's just a lot of pent up demand.
Normally when we think of copper or Freeport-McMoRan, we think of new housing because new housing has to have copper. So stocks like Freeport-McMoRan would go up. But with this, do EVs have to have copper in their manufacturing to being able to, or is it the battery that needs the copper?
Yeah, there's copper all in an electric vehicle as well as building out homes and assuming we get a big infrastructure build out, there's going to be copper used in all sorts of things. So I just think anytime you have 4 times the amount of copper in an electric vehicle than a regular car, and we've only, I think last year it was about 10% of vehicles were electric vehicles that were sold.
Tesla got hit so bad last year, and it's up this year from January 1st to this show right now, but it's still not like the way it was prior to like last June or July of 2022. And a lot of it is because of Elon Musk, because of the tweets and such, but whatever. And of what we talked about prior, do you see car companies like a Tesla or Ford, GM, others investing in the EV trade as a way to go, or only the components of it?
When I look at Tesla, I just kind of see a very, very popular stock. And I've been saying this for a while now. And look, I've been wrong because it's done quite well until last year. But I think they've just got so much competition, nipping at their heels that, I'd rather be in, a play like copper, where I can be in any electric vehicle, whether Tesla's the winner or whether it's another competitor. I feel like that's the way to play. It's sort of like not buying the product, but buying the boxes with Amazon. They're going to ship boxes no matter what happens. So
let's hope that if it's a recession, that it's a soft one. If we do have one toward, let's say, the latter part, the second half of 23, how would you balance a portfolio? What type of sectors would it be a more advantageous for an investor to own?
Yeah, and I think all portfolios should be well balanced, and it's just kind of interesting, thinking about your viewers. If you had somebody that was on full retirement, that was just living off their income, very appropriate to have larger cap dividend, stocks as well as some fixed income in there. Whereas a younger investor that's still in wealth accumulation mode probably wants to overweight growth. We do have a little bit of growth and value, and I would think that growth would outperform pretty sharply in, again, the first part of the year, and value might do a little bit better in the back half of the year. And I think we can still, if we're up 5 or 6% on the year on the S&P, I think you could probably see that up 10 or 11 or 12% in total as you get towards the mid part of the year.
Well, this week, I mean, the S&P 500 got to 4,000, do you think that it's a head fake where it may start to drop later on? Or do you think that it, like what we talked before, is that the stock market wants to run so fast that it may drop a little bit, but now that we hit the 4,000 mark, we're going to be going north? Or do you think that it's a head fake and we're more southern exposure?
I'm pretty optimistic over the short run. Although I think we could probably close back at, 4,000 or 4,100, something like that, towards the end of the year. So I do think, and this is what we do at Villary and Company, we are individual stock pickers, and I'd be a little bit more nervous to sort of just put money in different exchange traded funds and spread it around everywhere. I think individual companies are going to be, sort of the way to play it. I think active management is going to have a very big part of 2023, in my opinion.
Today, you've got different other types of asset management, types of asset classes. I mean, you've got equities and you've got bonds like we discussed, but now you've got the cryptocurrencies, and that's what I'm thinking of. Or you can maybe think of the NFTs, but I'm thinking of crypto. Not a week doesn't go by that I don't get either emails from our viewers or people who ask me, Andre, do I own Bitcoin or other types of crypto? Well, now you've got Genesis filing for bankruptcy, FTX with Sam Bankman-Fried and others. Just what are your thoughts when you have a client that calls you and goes, Sandy, are we in crypto?
So we've avoided crypto. I believe in blockchain technology, which is basically the way that big money center banks or banks in general move fiat currency, from one bank to the other. That's how, it's backed by the dollar. As you start to get into crypto, and you had blockchain that would move, non-fiat currency, I get a little bit more nervous. It sort of feels like to me that we could be, trading Mardi Gras doubloons or something like that, and just say that it's worth $20,000. If we all agree to it, it doesn't make sense to me. And I sort of believe in, Warren Buffett, Jamie Dimon, that have both said it's a, financial disaster waiting to happen. And I would rather. I feel like it's musical chairs, and I don't want to be standing there without a chair when the music stops. So I'd avoid crypto altogether.
I think Charlie Munger from Warren Buffett and Berkshire Hathaway, when he referred to it as rat poison.
And I know a lot of people have said just put 1% of your assets. Well, I like 1% of my assets, and I'm not sure I want to put it in cryptocurrency where I really can't. I can't figure out where it's going. If I can't tell you what it's worth in the future because I can't discount back the earnings, I've got a hard time buying it. And we'll see many other fads and popular stocks and things like that over time. But this feels like a pretty big one in my opinion.
Sandy, I had a great time. I hope you come back.
Thanks for having me, Andre. I enjoyed it as well.
Thank you, Sandy. Well, if you have a question about finance or a comment about the show, we'd love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. Now let's look ahead for market information for next week. But first, McDonald's started what new feature on this day in 1975 at their Sierra Vista, Arizona restaurant? We'll have that answer in just a moment. And McDonald's started what new feature on this day in 1975 at their Sierra Vista, Arizona restaurant? The drive-thru. 48 years ago today. Hasbro is cutting 15% of their workforce, amounting to about 1,000 jobs, warning of weak holiday sales in their upcoming quarterly results. And for those viewers in Louisiana that may be on Blue Cross and Blue Shield, Elevance Health has agreed to acquire both Blue Cross and Blue Shield of Louisiana and is expanding its Blue business into new states. Blue Cross of Louisiana has just under 2 million members and accounts for 1/3 of the state's population. No time frame as to when the deal will be completed. Now, coming up in 2 weeks, we're going to be talking with the editor of the Wall Street Journal, John Busey. And is cable dead and streaming alive? Join me next week when my guest is going to be Felix Gillette and John Koblin. Felix is the entertainment editor for Bloomberg News, and John is the media reporter for the New York Times. They've written a great book about cable and cord cutting and HBO called It's Not TV. Well, if you've enjoyed The Sopranos, The Game of Thrones, or Sex and the City, you're going to enjoy some of the back scenes of what was going on and just how HBO was built into the powerhouse today. That's John Koblin, media reporter for the New York Times, and Felix Gillette, entertainment editor for Bloomberg News, next week. And as a reminder, we repeat the show on Sunday mornings. Best way, though, set your DVR so you'll never miss an episode. And that is our show for this Friday, January 27th. I hope you enjoyed it. My thanks so much to Sandy Villary for joining us this evening. But as always, it's you. We appreciate you for allowing us to come into your homes tonight. So remember, always follow us on all the social media on Facebook and YouTube, Twitter, and WYES.org. Have a fun weekend ahead with the ones you love and a productive week as well. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.